Hello, I'm Sam Meredith and welcome to the weekly wrap-up, where joining me to discuss the market movers this week is Director with Fathom Financial Consulting, Erik Britton. So Erik, US preliminary GDP data was released this afternoon, which showed a contraction of 0.7% for the first quarter of 2015. A resurgent dollar and unusually heavy snowfalls were likely key contributors, but what is your assessment of the overall health of the US economy?
The overall health we think is fine. What's strange about the Q1 data is in 4 of the last 5 years there's been an unusually inclement weather period in the first quarter of each of those years, and that's translated into inverted commas surprisingly weak growth in each of those years. Our judgment on that is when you get that 4 years in 5, you need to start looking at how you think about seasonality and seasonal patterns and so on. And I think we'd start to advise the US statistical authorities to have a think about that maybe the Q1 seasonal adjustment isn't correct in their GDP data, because you've seen a very similar pattern in 4 of the last 5 years. Maybe this has to do with climate change, maybe it's something else, I don't know, but it's starting to look like there's a seasonal pattern that's not being picked up correctly in the data. The pattern this year, the revisions and so on from the announcement, the flash estimate, and then the revision now is very, very similar to what we saw in the first quarter of 2014, and for the same reason, weather-related reasons. But the underlying strength of the US economy remains in place. So, for example, corporate profits in the US as a share of GDP are higher now than they've ever been, as far back as the recorded data go, back to the 1950s. They're higher than they've ever been as a share of GDP. And the labour market is tightening rapidly, and we expect that tightening to continue. And for those reasons, on the domestic side of the US economy anyway, once we're through the adverse weather implications and impacts, we'd look for a return to pretty robust growth in the US going forwards.
At the same time as this US data release, we saw Canadian monthly GDP shrink by 0.2%. Bank of Canada's Governor Stephen Poloz had said this week that a strong bounce back for the US would support growth for the Canadian dollar later in the year. Do you share this optimism for the Canadian economy, and what can we expect in the short term?
I mean, obviously Canada is closely related to the US for a whole host of reasons, and I expect they can think about benefiting from some coattails effect, so to speak, as the US powers on through the remainder of this year and beyond. But Canada has another thing that's driving it, which is oil, and the reduction in global oil prices is going to hit Canadian investment, which we've seen already, not just now, but possibly for the next several quarters too. And that's a bigger deal in Canada as a share of its GDP than it is in the US, for example, a substantially bigger deal. And it's not only going to hit the investment side, it's also going to hit income and therefore consumer spending. And again, we've seen that. And unless you think the oil price is going to turn around soon, which is not our view is it may pick up slightly, but it could even fall further from here. But we don't see it returning to $100 plus as it was a year or so ago. Unless you saw that on the cards, then I wouldn't expect to see strong growth in Canadian demand. I'd expect to see it underperforming vis-a-vis the US over the next year or so.
And lastly for today, which key indicators will you be looking out for next week? Are there any potential surprises in store for us to keep our eyes on?
Yeah, the big one is payrolls, which comes out next Friday, US payrolls. There's one or two other smaller issues along the week, but the big one to look out for is payrolls. If we're right about the underlying strength of the US economy, then we'd be looking for really quite a strong number there. I think anything north of 200,000 in the US would be regarded as consistent with steady, robust growth in the US economy. Our forecast is for 300,000. It could even be more than that. And if it comes out like that, then that would be consistent with a big bounce back in the second quarter relative to the first quarter, and would be more grist to the mill of the idea that the underlying strength of the US economy is still there, still pretty robust.
Thank you, Erik. For more updates and to see how the markets are shaping up next week, join us again for the week ahead on Monday. Goodbye for now.